Thank you. Thank you for being here tonight. We have a really, really great program planned. And I know some of you may be aware that we offer this program every um, few years. And I know that every time I've attended it, I've learned something that was really practical and helpful as well. So really happy that you're here. We are recording this, so many people who signed up will be probably watching it on recording separately. We have three truly expert speakers with us tonight, and we are very fortunate that they are each sharing with us their expertise and their advice. Since we're not a large group, we do not need to be very formal about Q&A. So if you have a question, you can just jump on in or raise your hand or put it in chat, or you can wait till the end when we have time as well. But if you have a question that you think is really timely, don't feel that you need to sit on it. And I'm sure the speakers will let you know if we're going to be covering that material separately. So we do have three, as I said, three expert speakers: Adam Stock, Ted Frum, and Steve Reikus. I'll introduce each of them as they speak. I laughed out loud and so enjoyed Adam's bio. So I'm going to actually read that because I thought I knew you, Adam, but I didn't know everything about you. So let me first introduce Adam, who will be sharing some great material for us. As a Beth Emmet-based Sayfair student 38 years ago, Adam's two front teeth were broken on the winer room floor, the result of an enthusiastic Israeli dancing partner, which sounds like a whole separate conversation. 10 years later, Adam cut his teeth as an investment advisor, and for over 2 decades has been helping clients navigate the many financial challenges in the present so they can experience a more meaningful and joyful financial future. He survived 4 winters in Minnesota and graduated from Carleton College, cum laude. He also performed additional coursework at the London School of Economics. Dedicated to honing the craft of financial planning, Adam obtained his CFP and the exclusive Master of Science degree in financial planning. He's grown a solo practice into a team of 18. His company, the Next Level Planning Group, helps solve an acute structural problem that exists in the financial services industry, going way beyond simple better than tactics to discover optimal strategies. He regularly lectures to groups on topics such as Social Security optimization, charitable giving, and personal financial planning blind spots. This August, Adam will celebrate his 23rd anniversary with his wife, Melinda, a Jewish farm girl he met in college. Adam was the president of the Jewish students at Carleton, hard to believe, and their first date was Shabbat dinner at the Jewish students' house. Their courtship developed as Adam tutored Melinda in calculus. How'd she do in that calculus class, Adam?
God, nay.
They didn't multiply, though, till much later, and now they have 5 wonderful children, ages 4 through 16. When he's not working or spending time with his family, you can find him sleeping, as you can imagine. When he's able to muster additional energy, you can find him playing basketball, violin, and volunteering at Beth Emmet, where he's served on numerous committees, was a member of the board of trustees, and currently serves as a member of the Beth Emmet Foundation. So a really, really wonderful person, and we're very happy to have you here, Adam. So
Thank you. Thank you so much, Karen. I'm delighted to be speaking with you this evening. I'm going to start off with 4 tax-wise strategies for charitable giving. And I'm going to start with this first one, which is donating stocks and mutual funds. So I want to take an example of, you buy some stocks and some mutual funds, you bought them for $200. Now they've gone up in value, and they're worth $1,000. So you have these stocks and you've had these mutual funds over here in one hand, and then over here you have cash. And so, what I find is that most people are in the practice of writing checks or, putting donations on credit cards. And what happens is if you give cash, what happens on the left-hand side is when you sell the stocks and mutual funds, you have to pay capital gains tax. And so if you pay 20% capital gains tax, $160 of that $1,000 is going to the IRS or the state, and then you're only keeping $840. So if you then take that $840 and give it to charity, the charity is now only getting $840, right? And the IRS is getting the other piece. Alternatively, if you take those stocks or mutual funds and instead you directly donate those to the charity, then what happens is you get a tax deduction. The charity receives the full $1,000, okay? And you receive $1,000 tax deduction rather than $840, and you avoid paying capital gains tax. So there are numerous members at Beth Emmet that instead of giving cash or checks for mitzvah appeal or things like that, they donate stocks and mutual funds. And if you have questions about how to go about doing that, ask Becky. Other charities have investment accounts where they accept stock and mutual funds as well. So this is a great strategy that's not taken advantage of enough. Let me go to the second strategy, which deals with beneficiary designations. And this is one of my favorite topics. So what a lot of people don't know is that beneficiary designations supersede the language of your will or trust. So you could go to Ted Frum or another estate planning attorney, and you can have masterful documents. But if your beneficiary designation says, my IRA goes to XYZ, no matter what it says in your will or your trust, the beneficiary designation supersedes. So what happens to your IRA when you pass away? I'm going to take some audience participation here. Who knows? You can come off of mute. Who knows what happens? And Stephen, you're not eligible to answer this question. Who knows what happens when you pass away with an IRA? Anybody?
It goes to your beneficiary and taxes taken out.
Okay, good answer.
If it's
good answer.
unless it's a charity.
Largely correct, Mike. So it depends on whether it goes to a spouse or a non-spouse. So if you have an IRA and the beneficiary is your spouse, then when you pass away, that IRA will go to your spouse without any tax, right? And then when your spouse takes that money out, then he or she will pay tax on it, okay? Now, what kind of tax will they pay on it? Well, they'll pay ordinary income tax, which could be as high as 37%. They might also have to pay estate tax on it, right? So, what's true is that 70% or more of your IRA may go to the IRS when you pass away. Now, that's an extreme example, but it is possible for that to happen. Now, as Mike alluded to, if instead of making individuals the beneficiary of your IRA, you make charity or charities the beneficiary of your IRA, or a donor advised fund, which is what Ted is going to talk about later, right? Then again, all of that money is going to go directly to the charity or charities without any income tax or estate tax. So one of the strategies that we help our clients with is setting up a charitable IRA during their lifetime. So, you might have an IRA that has $120,000 in it, and you might say, hey, you know what? I don't think that I'm going to use all of this, so let me just take $25,000. Let me put it in a different IRA, right? And I'll keep my spouse or my kids the beneficiary of the big one, but let me just carve out this other charitable IRA. And then that IRA will have the beneficiaries be the charity or charities, so that you would know that at least a portion of what you own is going to go to the charity or charities. And this is a changeable decision. You can always move the money back and forth. But for some people, this is a nice way to kind of think about, okay, this is the part of my IRA that's going to go to my family, even though they're going to pay tax on it. And then this is another IRA that is not going to be taxed. It's going to go directly to the charity or charities. Any questions about that before I move on? We have a smaller group, so we're open for questions.
I don't have a question, but I want to let people know that after hearing Adam a couple years ago explain that to Karen and I, we switched our IRAs and actually split them into 2 different IRAs for each of us. So a plug to you, Adam.
All right. Well, I appreciate that. And it makes me feel warm and fuzzy inside that I don't just talk and that people do take action. So thank you very much. I'm very glad to hear that.
I'd also add, it's really easy. People think, oh, changing beneficiaries. It couldn't really be much easier. So I don't want anyone to feel intimidated by it being like you have to go get a lawyer to do something.
Correct. Yep. Very easy. Thank you. Okay, so that's the second strategy is just be very intentional and understand what's going to happen to your IRAs when you pass away. So the third has to do with the difference between standard deductions and itemized deductions. And so going back to 2017, at the end of 2017, Donald Trump, who was president at the time, passed the Tax Cuts and Jobs Act, which was sweeping legislation. One of the things that it did is it raised the standard deduction considerably. When you file for taxes, you're able to take the larger of your itemized deductions or your standard deduction, whatever is greater, right? So the standard deduction is very high. In fact, in 2023, if you're single, the standard deduction is $13,850, and I'll be giving some examples in just a few minutes of what this actually means. And if you're married, it's double that, $27,700 in 2023. Okay. Now, you also get a bonus if you're over 65. So the standard deduction is even higher if you're over 65, right? 15,350 and 30,000 respectively. So let's look at what happens. Here's an example. We've got Rob and Roberta. They're 75 years old, and they can either take the larger of standard deduction or itemized deductions. Well, the three main itemized, so the standard deduction is $30,000, as I just mentioned. And the itemized deductions are typically a combination of your real estate tax, your mortgage interest, and donations. Those are the three big ones, okay? Real estate tax, mortgage interest, and donations. So let's say that they have already paid off their mortgage. They have $15,000 of real estate tax. But another thing that happened with the Tax Cuts and Jobs Act is they capped the amount of real estate tax that you can deduct each year to $10,000. Okay, so even though they're paying a lot more, they can only deduct $10,000. So what you see here is that if they don't make $20,000 of donations, they will get zero tax benefit for that, because they'll be equal taking the standard deduction than the itemized deduction. I'm not saying that the only reason you should give to charity is because of the tax deduction. That would be silly. But like, I think that if you do give to charity, you'd like to be able to, maximize that for the charity. You'd like to be able to maximize that on your tax return. And so there's this big donut hole here, and it's important to understand that, and now some strategies on how to circumvent that. So how could Rob and Roberta circumvent that? Well, they have a strategy available to take some of the required minimum distributions from their IRAs and make direct charitable contributions. And this is strategy number 3. It's called a qualified charitable distribution. And so this is really powerful because it accomplishes many things. It essentially allows you to get a deduction by donating directly from your IRA. And this is important. It has to go directly from the IRA to the charity, right? Can't stop, can't pass go, can't come into your individual account and then go to the charity. It has to go directly from the IRA to the charity or charities, okay? Then it doesn't even hit your tax return, and then it doesn't increase your income, which therefore would increase your Medicare premium. So there's a lot of virtue in doing qualified charitable distributions. Okay, again, I'll pause for questions. Any questions about the QCDs, as they're called, or qualified charitable distributions?
I have a question. I think I know the answer. Is there any way to make a direct charitable contribution out of your IRA before you have the required minimum distribution? Because they keep raising that.
Yeah, so you know what?
If you're 69,
yeah, great question.
Is there any way to make a charitable deduction and not have it taxable?
Yeah, it's a great question, Mike.
The required minimum distribution.
Yeah, it's a very good question, and it actually goes into my next slide. So great timing.
What do we do?
As you alluded to, the Secure Act 2.0 was recently passed in December, and what it did is it pushed back the age, as Mike just mentioned. So it was 70 and a half, and then the Tax Cuts and Jobs Act pushed it back to 72, and then Secure Act 2.0, Secure Act 1.0 pushed it back to 72, and then Secure Act 2.0 just pushed it back to 73 and 75, right? So, so then what? So, what if Rob and Roberta are 71? They haven't taken their required minimum distributions. Well, what can they do? Well, you can give IRA money directly to charity if you are over 70.5. So that was the old rule, and they just kept the old rule. If you're 69, you can't do the QCD. But as if you're 70.5, even if you haven't taken your required minimum distributions yet, you can still do the QCD strategy.
So let's say I still got a few years before I'm 70.5, and I get to be 70.5. There's still a limit on how much you could give and still get it qualified? Because it used to be tied to your minimum distribution, right?
No, it's not. It's not. As long as you're eligible to take required distributions, as long as you hit that age threshold, then theoretically you could give $50 of IRA money to a charity. Did I answer your question?
No, but I'm not anywhere close to that. So when I get
Okay.
closer, I'll talk to you.
Okay, that's yeah. There is a maximum the maximum that you can do in any given year is $100,000 from IRA. Faye has her hand up.
Yeah, my question is, if you have a required minimum distribution because of an inherited IRA, how does all this apply?
Great question. So for a little bit of context, for those of you that maybe didn't follow the full question, if you inherit an IRA and you're a non-spouse, so one of your parents passes away and you're the beneficiary of that IRA, right? You have to also take distributions from that IRA over a 10-year period, irrespective of how old you are when you inherit that money. Okay. And you may not, inherited IRAs aren't eligible, unfortunately, Faye, to do the QCDs.
That's what I thought, but I want to make sure.
Yep. Sorry about that one. I didn't make the laws. If I did, I would have given that, QCD eligible for the inherited IRA. Okay.
So, and that doesn't matter. My age doesn't make any difference. In other words, I can be 90 and the inherited IRA still isn't ever going to be eligible.
That's right.
Okay.
That's right. Now, I mean, what you could do, right? Like what you could do, Faye, is you could take the money out of the inherited IRA. And if you're not personally contributing to an IRA, you could put the money in that IRA and get a deduction. And then you could take that IRA money and you could do a QCD with that IRA money. And if you want me to repeat that, we'll just meet another time and after Sunday school, and I can go through that one again.
Got it.
But that would be something that you could do, in essence, getting your inherited money into a QCD situation. Okay, other questions? All right, so let's return back to Mike's question. Well, what happens if you're under the age? Then what do you do? So we have an example of Evan Stone. Evan is 60 years old. What's Evan going to do? So he has a standard deduction, which is $13,850, and then he has itemized deductions on the right-hand side, which add up to $11,850. So you can see that there's a gap. There's a gap between the right-hand side and the left-hand side of $2,000. So the first $2,000 that Evan donates to charity, he will get no tax benefit for. Okay? Because he would have been better off, just as well off taking the standard deduction. So then what we do is we do a strategy that's called bunching. This is the last strategy that I'm going to talk about. And with bunching, and Ted is going to talk next, he's going to build on that. What we do here is we basically, in 2023, we make a double contribution of $4,000. And then we itemize. And then the next year, we don't make any contributions, and we take the standard deduction. We do this back and forth. And by doing this, we're going to end up getting some tax benefit for that $4,000 in the years that we itemize. Okay. Now you might say to me, well, Adam, What happens if I don't want to give $4,000 to charity one year and $0 the next year and $4,000 to charity? What I would really like to do is I would like to just give $2,000 a year to whoever I want to give $2,000 to. And that's an alley-oop to Ted, because he's going to talk about a strategy where you can accomplish exactly that. So let me summarize, and then I'm going to turn the mic over to Ted. What did we talk about? Ideas: donate stock or mutual funds that have gone up in value instead of cash. Consider creating a separate charity IRA and naming charities as the beneficiaries. If you're over 70 and a half or older, consider using your IRA for QCDs, the qualified charitable distributions. If you're younger than 70 and a half, consider a bunching strategy. And finally, make sure that your beneficiary designations are part of an overarching strategy.
Adam, thank you. Faye has a question for you.
No, I did. I just got rid of it. Thank you.
Thanks.
Yeah, it's one of those
Are there-
Zoom things, the digital hand stands up and then it comes down. And so back over to you, Karen, and then over to
Yeah.
Ted.
And we do have time at the end for more questions as you start hearing about it. Thank you, Adam, for that great information. And it makes me want to go have a banana, but I like that bunching strategy. So I'm delighted to introduce Ted Frum, who has been practicing law since 1999. He's getting good at it by now, I hope.
Still practicing.
And still practicing. His firm, which is located in Evanston, focuses on tax-efficient trust and estate planning and administration. So this is going to be very relevant to those of us interested in this. Before entering the practice of law, Ted worked in state and local tax group of KPMG Pete Marwick, and was admitted to practice law in Illinois, or is admitted to practicing law in Illinois, Michigan, and Florida. So thanks, Ted, so much for joining us, and we're looking forward to learning from you tonight.
It is my pleasure, and I'm going to share my screen. Can everybody see that? Awesome. All right, Adam, you're a tough act to follow. I will try to do my best. Everybody, I'm going to talk about 3 strategies tonight. One totally terrific giving strategy that I think is just the best thing since sliced bread. And then 2 other pretty good, but complex and a little more expensive charitable giving strategies. So I'm going to talk fast to keep my part of this speech to under 18 minutes. So, all right. Let's see if I can do this. There we go. First strategy, donor advised funds. I love donor advised funds. They cost nothing in terms of legal fees, nothing in terms of accounting fees. Let me talk about it. A donor advised fund is like a cash or investment account for the sole purpose of supporting charitable organizations you care about. When you contribute cash, securities, or other assets to a donor advised fund at a public charity, you are generally eligible to take an immediate income tax deduction. You can keep the donation in cash or invest those funds for tax-free growth. You can recommend, and I stress recommend, not dictate, grants to virtually any IRS qualified public charity. Let's take an in-depth look at how the donor advised fund works. Number 1, you make a tax deductible donation. You can establish a giving account at a charity. I have one of these accounts. It's at the JUF. There's a lot of them all over the place. I think Adam may have some connections to manage some charitable funds in that manner. So you establish the giving account at a charity, and then you donate cash, stocks, or non-publicly traded assets, such as a private business interest or crypto. I'm not sure what happened there. Hold on one sec. There we go. Any type of kind of non-standard asset in order to be eligible for an immediate income tax deduction. A contribution to a donor advised fund is an irrevocable commitment to charity. The funds cannot be returned to you or any other individual or used for any purpose other than grant making to a charity. Number 2, you grow your donation tax-free. While you're deciding which charities you want to support, your donation can potentially grow. It could be invested, making available even more money for charities. Most sponsoring organizations have a variety of investment options from which you can recommend an investment strategy for your charitable dollars. And number 3, you support charities you love now or over time. This is really like a charitable checkbook. You can support virtually any IRS public charity with grant recommendations from the donor advised fund. From your local homeless shelter to your alma mater, or even to a fabulous religious institution like Beth Emmet. The public charity sponsoring your account will conduct due diligence to ensure that the funds granted go to an IRS qualified public charity and are used for the proper charitable purposes. So how do you turbocharge a donor advised fund strategy? Let's talk about how to do that. As soon as you make a charitable contribution, you are eligible for an immediate income tax deduction, just as you would by donating to another public charity, like your local shul, homeless shelter, food pantry, wherever. But some donations could make you eligible for additional benefits. Let's start with regular cash donations. If you donate cash via check or wire transfer, you're generally eligible for an income tax deduction. I think it's up to 60% of your adjusted gross income. However, you can do better. And this is to build on what Adam said before. If you donate long-term appreciated assets like stocks or securities directly to the charity, instead of selling them and incurring the tax and then donating the proceeds, you can maximize both your tax benefit and the overall amount that you have to grant to the charity. The donations essentially provide two tax benefits, just as Adam said before. First, they eliminate capital gains tax on the long-term appreciated assets as long as they've been held for over a year. And second, the donation of the assets becomes eligible for an income tax deduction of the full fair market value of the asset up to 30% of your adjusted gross income, if I'm not mistaken. So let's talk about another turbocharged technique, bunching. Again, Adam mentioned that before. He had bananas, I have grapes. You could tell we like to snack. For 2023, the standard deduction for single people, as Adam mentioned, is $13,850. It's $27,700 for couples. So if you donate less than those amounts in a given year, you don't get an income tax benefit for them. So instead of giving a smaller amount once a year, which doesn't benefit you income tax wise, you maybe try to double the amount to your donor advised fund every other year. And a quick example, again, just to build on what Adam said. Let's say you got Benny the bachelor. He normally gives 10 grand a year, but the standard deduction is 13,850. So if he changes his strategy and gives 20 grand every 2 years, the result is that he gets an extra 6,150 bucks to use in a charitable deduction every other year rather than nothing every year. I think Adam said earlier, of course, we don't give much to charity just to get a charitable deduction. So if somebody prefers to give every year, go for it. Don't let the tax tail wag the dog. You know, if you can build in the benefit, great. But if it gets in the way of your donative intent, your goals, you know, go with your goals. Turbocharge technique number 3, you invest your donation for tax-free growth. Once you've funded your donor advised fund, you put money into the fund. You can recommend an investment strategy for your account, potentially growing the account and providing you with more dollars to grant to your charity. Many sponsoring organizations also have programs allowing you to nominate your financial advisor, such as Adam, to manage the investment of your charitable funds. Now, here are a few caveats about donor advised funds. With them, you generally cannot support organizations other than IRS qualified 501c3 organizations. You can't give donor advised fund money to political groups or crowdfunding campaigns or private foundations if you have one. You also cannot recommend grants that may provide you with a personal benefit, such as a school tuition for a grandchild or tickets to a charity event that you want to attend. Because you would receive something of personal value from these grants, they're not eligible for the grant, just like they wouldn't be eligible for an income tax deduction. Donor advised fund dollars are really to be strictly used for charitable purposes, such as a scholarship program to your alma mater or contributions to your shul. Did I mention that? Finally, you can't make a qualified charitable distribution, the QCD that Adam mentioned, from your IRA to your donor advised fund, if I'm not mistaken. All right, I obviously have talked a lot about donor advised funds. I love them. People come into my office and they'll say, oh, I want to create my own private foundation. I'll say, you really don't. Unless you're talking huge money, you're throwing a lot of money away at lawyers and accountants. If you really want to stretch your charitable dollars, just create a donor advised fund. I have that conversation at least half dozen times a year. All right, I'm sick of talking about donor advised funds. No more. I'm going to talk about the next strategy. Charitable lead trusts. Now, I've been told that this is an advanced crowd, so I'm going to assume that everybody knows what a trust is. It's a type of legal entity. So I'm going to dive right in and talk about charitable lead trusts. Charitable lead trust is an irrevocable trust designed to provide a set amount of financial support, either an annuity or a percentage of the trust assets, to one or more charities each year for a period of time, with the remaining assets eventually going to family members or other beneficiaries chosen by the person who creates the trust. Those folks are called remainder beneficiaries because they get the remainder of the trust's assets. One second, just having a glitch on the screen. Sorry, so the remainder of them get what's left after the charitable payout. So a charitable lead trust can be funded either during your lifetime or by the terms of your estate plan documents after you are deceased. It's a strategy most frequently used by the charitably inclined for estate and gift tax planning purposes. It can provide benefits such as an income tax.
I think we may have an internet glitch in Ted's house. Give him a second to resurface. I'm gonna guess he's gonna disappear and then come back. Adam, do you want to give him a quick text to just see if he's going to be moments or?
Sure. Yep.
Thank you so much. The cliffhanger. Oh, there he disappeared. Here he's coming back in. There you are. We missed you.
Was it something I said?
Yeah.
Apparently, let me get back to my screen.
We lost you just sort of setting up what a charitable lead trust was, just so you know where you started freezing.
Thank you. All right, hopefully you can see that. Hopefully I also didn't like freeze when my face was or something.
No, it
like
was an excellent freezing position.
All right, tell me where, just so I don't bore you by going back too far, remind me where I left off.
A lot of people set them up to as part of their charitable
Got it.
estate planning.
Okay. So this can potentially provide benefits such as income tax deductions or estate or gift tax savings on assets ultimately passed to the individuals designated as the remainder beneficiaries. At the same time, the trust distributes regular payments to benefit a preferred charity or charities during the term of the trust. Let's talk a little bit about tax, not too much. So you get a gift tax charitable deduction if you make the gift while you're alive. It's not 100 cents on the dollar because there are strings attached. Essentially, you get a gift tax deduction only on the amount of essentially the present value of the payments that are to be made to the charity, and not for what's eventually going to be made to the non-charitable remainder beneficiaries. After a set term of years, non-charities such as your kids maybe get what's left in the trust. The idea is that you put in an asset that you know is going to appreciate in value at a much higher percentage than the payout rate going to charity. This way, the extra appreciation goes to your loved ones at a tremendous gift tax discount. You also get an estate tax deduction if you make the gift through your estate plan to take effect after you're deceased. The same deduction valuation rules that I just described apply in this scenario. What about the income tax? The rules are ghastly. They're super complicated, so I don't want to go too far into the weeds. Essentially, there's two types of charitable trusts. There's something called trust number one, a grantor charitable lead trust. In this trust, the creator of the trust, called the grantor, can take an immediate income tax deduction for the present value of the payments that are going to be made to the charity, subject to deduction limitations. However, the benefit should be considered in conjunction with the fact that in future years, during the trust term, the trust investment income is taxable to you, the creator of the trust, not the trust itself. This is good if you receive a huge pile of income in a year that you establish a trust. You get a giant bonus from work, you sell a business, something like that. So you get a big tax deduction in year one, which you can use to offset the income hit. In subsequent years, you include in your income whatever the trust is earning. Essentially, you're spreading your income out from 1 year over a term of years, hopefully hitting a lower rate. The second type of charitable lead trust is called a non-grantor charitable lead trust. With these types of trusts, the trust and not you, the creator, is considered the owner of the trust assets for tax purposes. So the trust pays its own freight. All right, it pays its taxes, not you. And you, the creator of the trust, however, are not eligible to take an income tax deduction for the gift to the trust in the year that you make it. The trust gets to claim an unlimited income tax deduction against its own income whenever it makes a distribution to charity. This trust is good for you if you don't want to include the trust income in yours during the trust term. Now I'm going to talk about the inverse. This is the third strategy, something called a charitable remainder trust. This is the reverse of what I just described. 3 points I'll hit on. Number one, you make a partially income tax deductible donation. With this strategy, you donate cash or whatever other asset, and you become eligible to take a partial tax deduction in the year you make the transfer. The trust sells the assets, thus the built-in capital gains tax that you'd have to pay if you sold them if they're appreciated, that's avoided. The partial income tax deduction you get due to the donation is based on the term of the trust, the projected income payments, the IRS interest rates that assume a certain rate of growth. You also get a gift tax deduction for amounts given while you're alive, or an estate tax deduction if you do the strategy as part of your estate plan. Point number two, you or your chosen beneficiaries receive an income stream now. So it's again the opposite. Instead of charity first, trust second, you get the income stream, or somebody you choose, the charity gets it later. Based on how you set up the trust, you or your stated beneficiaries, you can receive the money annually, semi-annually, quarterly, monthly. For the IRS, that annual annuity has to be at least 5%, but no more than 50% of the trust assets. Point number three, after a specified period of time, or if you prefer the death of the last income beneficiary, the remainder of the assets, they're distributed to the charity you designate, such as Beth Emmett. Depending on how the CRT, this charitable remainder trust, is established, the trustee may have a power to change the charitable beneficiaries during the period the trust exists. All right, when should you use a lead trust versus a remainder trust? So this is me finishing up my last about minute. First and foremost, you should have some professional advisor, CPA, tax lawyer, financial advisor, do the arithmetic to see which will give you the best income, estate, and gift tax benefits. Candidly, when interest rates are super low, a lead trust is a good idea. When they're higher, the remainder trust is a good idea. Point number two, the remainder trust is a good option if you want an immediate charitable deduction, but also have a need for an income stream to yourself or another person. It's a good option if you want to establish one through your estate plan to provide for heirs for a period of time, with the remainder going to charities of your choosing. And finally, a lead trust is a good option if you don't mind losing access to the asset. All right, that's it for my presentation. Hope I didn't go too far into the tax weeds.
Yeah. Let's pause for a moment and see if people have questions about these trust ideas and the other strategies that Ted provided.
If I haven't put you all to sleep.
The one question I had was about you use you referenced the term of the trust a number of times. Is there a typical length of term or a regulated length of term? Long, short?
The few times I've used these strategies, I've kind of built on how long we think the client wants the trust to last, and then we model some numbers, and maybe we'll adjust it. You know, it just depends on what somebody wants and whether they want to do it after death through their estate plan, or like with the remainder trust, they want a stream of income for a while. So there's no rule of thumb.
Okay, thanks. Any other questions at this point? Okay.
Well, I shall hand off to the fabulous Stephen Wilkins.
Right. And I am honored to introduce Steve Rikus, who is a very old friend. Steve and I met freshman year at Northwestern. He got his degree in economics in 3 years, and then took some time off in Israel, and then got his JD at the University of Chicago. I guess he's working his way through major universities in the Chicago area. Steve and his lovely wife Sherry live in Evanston much of the year, although they've become recent snowbirds, and they enjoy their time together without children or dogs. Steve has been involved in a number of aspects of Beth Emmet, former treasurer of Beth Emmet, I guess the immediate past treasurer. He's current member of the Beth Emmet Foundation Board and a member of several committees at the Jewish Federation. He's an avid cycler, tennis player, bridge player, and a real Renaissance man. So delighted to have Stephen share his strategies and to build on what we've heard on tax-wise charitable giving.
So, Adam and Ted really talked about tax strategies, and I really want to kind of talk about it in a more practical way, is how can we take those strategies and use them as an effective way, right? And when you look at how people make gifts, I kind of divide it into 3 separate categories. There's a lot of people just make annual gifts. You write a check every year to your charity of your choice, or you make a gift of stock every year to the charity of your choice. Your charitable gifts are really made on a year-by-year basis, and you really come down to it. That's how most people make their charitable gifts. They just make annual gifts every year, whether it's a checkbook or whether they use stock. They're making their gifts just year by year, right? And one thing that we also do is sometimes you make gifts on a multi-year plan, right? Think of the Truma campaign, our fundraising campaign, where Beth Emmet members decided to make gifts of X dollars a year for 4 or 5 years. It's a thought out, planned gift, right? When Adam talked about bunching or chunking, making gifts in a lot of gifts in 1 year, every other year to get your tax benefits, that requires multi-year planning. Or when Ted talks about the donor advised fund. Well, if you're doing a donor advised fund, you're not thinking year by year, you're thinking long term of how do I make gifts over a long period of time, right? But what I really want to talk about is the third way of making gifts, and that's known as the legacy gift. And Beth Emmet, as many of you should know, or all of you know, has a program called Door to Door, which is a program designed to promote legacy gifts to Beth Emmet. It's designed to encourage individuals to give money to Beth Emmet upon their passing. And Karen will talk into a little more detail on this topic. All right, next slide, please. So why do individuals make legacy gifts? Why does someone make a legacy gift as opposed to a lifetime gift or a gift during their lifetime? And I think there's, kind of 3 separate reasons you could say. One is many times donors are afraid that they're going to run out of money. I don't want to give money to Beth Emmet because I may need this money. I don't know, I may live longer than my life expectancy. I may have unanticipated health expenses. I really would like to give more money to Beth Emmet, but I'm just kind of, I'm afraid to do so because, I don't want to be dependent on my children for funds. I don't want to have to go into, the poor, the proverbial poorhouse. So I'm just going to hold on to my money. But you know what? I'll give money to my charity or to Beth Emmet upon my passing, because as a general rule, you can't use the funds after you pass away. It's not. You don't need to use it. So you see a lot of individuals will say, I'd like to give you more, but I'm afraid. And I guess the response is, well, perhaps giving it upon your passing is a palatable choice, right? Adam described how legacy gifts can be very, very tax efficient. For individuals who are subject to estate tax and who have IRA or retirement funds, the tax rate on assets that you leave to your children can be significant, if not 50, 60, 70%. And so giving money to charity upon your passing can be very, very tax efficient. And the third reason why individuals, I think, give money as a legacy gift is, and this is something that Sherry speaks about a lot, is A lot of donors want to pass their values to their children or to their heirs in addition to their valuables. Many donors think that philanthropy is a very important part of who they are, and they want to impart that, that value of philanthropy to their children or grandchildren. Well, the way you impart values is just not by talking about them, but by doing them. It's, is it walk the walk, just don't do talk the talk, walk the walk, or something of that nature. And so you hear individuals making charitable gifts upon their passing in order to show their children that philanthropy is important. And to me, there's a meaning to that. Having children in their early 20s who are really beginning that process of developing their adult values, showing to them that we're philanthropically minded, kind of instills in them that they should be philanthropically minded also. Sometimes you don't know whether that works or not, but you just, as anyone with children, you just do your best and you cross your fingers and you pray. Next page, please. All right. And so how mechanically do you make a legacy gift, right? Option number one is amend your will or revocable living trust. Generally involves an attorney and there's a cost involved, right? But as Karen mentioned earlier, an easier way, a less expensive way, more is to amend your IRA or pension plan beneficiary designation. You don't need an attorney. It provides you tax benefits, which Adam discussed. And all you need to do is get that change of beneficiary form from whether it's Schwab or Merrill Lynch or from Adam, and just say, hey, I want to leave X thousand dollars to my charity of my choice, and the balance I give to my children. Or you can do it as a percentage. I'll give 1, 2, 3, 5% of my IRA to charity, and I give the balance to my children. One of the benefits of using percentages is as the IRA grows, your charity will get more, will share in that growth. And if there's a reversal and for whatever reason, the account goes down because we have another stock market like we did last year, the amount that goes to charity will also go down. So there's some comfort in using a percentage in what goes to a charity as opposed to a flat dollar amount. But both systems really kind of work. And now I think next Karen's going to tell you why we should the tax efficiency. I'm sorry, I'm going to kind of repeat a little bit of what Adam said here. We don't get to use the stretch IRAs anymore. Charitable gifts from IRAs and retirement plans are not subject to tax. For donors, we're subject to federal state tax. Gifts, charitable, the taxes can be significant, and charitable gifts can really reduce the amount of estate taxes payable. And so that's why a lot of wealthy individuals really use this legacy way of giving in order to save their taxes. And now Karen will talk about why Beth Emmett should be on the top of your list when it comes time to making a legacy gift.
Thanks, Steve. And I'm just going to cover a couple things quickly, and then we can open it up to additional questions people have. So we've learned a lot tonight, and I've got a whole bunch of notes here of things I want to think about. But I do want to just spend another moment talking about Dor Lador, which means from generation to generation in Hebrew. Stephen was part of a team that founded this Dor Lador program about 15 or 16 years ago, which is just a formal Beth Emmett program to encourage our members to leave a legacy gift to Beth Emmett in their plans. Technically, what happens is when people pass, their legacy gift becomes part of Beth Emmett's Assuring Our Future Fund, which grows and obviously provides income also to Beth Emmett. And it's really kind of mind-boggling and impressive that we've to date received over $500,000 for multiple bequests, some very small, some more larger as well, and everything in between. So it's providing a genuine sense of or genuine income to Beth Emmett. In addition, 100+ people, some people on this call, and many of our friends from the congregation have said that they intend to leave something to Beth Emmett. For those of you who've already signed up and shared your intent, I want to sincerely thank you for doing that. If you haven't yet and you're interested, I'm going to share a little bit more about why you might be interested. So As I think Stephen very articulately said, is it's a way to express your values beyond your lifetime. I know that Beth Emmett is really important to all of us on this call. And it's a big part of all of our lives. And I hope you share with me your interest in Beth Emmett continuing to be an important cornerstone of the Jewish community in our area for generations to come. Beth Emmett is solely funded by the generosity of our own membership. There's no other source of income. So makes your bequest even more important. And you be leaving by designating Beth Emmett in your will or trust or as a beneficiary of an IRA or a pension fund, as it has been described, you'll be leaving a gift of enduring support for which you will always be remembered. And it really is a real role model opportunity for each person. I recently talked to someone who's shared their intent to leave money to Beth Emmett when he and his spouse passed. And he said, I used to want to be anonymous about that intention. But he's recently changed his mind because he thinks it's important for his family, his children, his adult children, to understand that this is part of what being Jewish is, what being philanthropic means. So I was quite touched by that. The final slide is, how do I join Door Lador? You've been so moved by this presentation and this information, and you've been waiting for the opportunity. It really, really is easy. At this moment, all you need to do is go to bethemmett.org /give/legacy or navigate through our website to that. And it's really at this point simply sharing your intention. As you can imagine, it takes for some people some time to either plan to change their will or to get a beneficiary form or think about what the details are. But sharing your intention is really the major request for now, if you're so moved. There are no minimum requirements, and it's non-binding. People's lives change, people's circumstances change, and the term of your legacy gift remains under your control. And as we've talked about, it's really quite simple to do that. Becky is a real great source of knowledge, and I think she's probably gotten every question possible on Door Lador. So if you have questions, you can certainly reach out to Becky. I imagine Stephen and Adam would be happy to answer your questions as well. So it is really a meaningful decision. It's an important decision. Mike and I have signed up for Door Lador. We signed up, in 2006, and have made some changes over the years as our circumstances have changed and as our knowledge of the different vehicles has changed as well. And I would really, really encourage you to think about that as you continue to make your own plans for your financial situation. I want to just thank Adam and Ted and Stephen for sharing their expertise. Here are their phone numbers and emails as well. And I know that they'd be happy to answer questions at this point. I'm going to stop sharing. I see there's something in chat. Becky has put the link so that if you're so moved to do that, you can do that right now. But let's just open it up, and anyone have other questions or things they want to get a little bit more advice on or understand better? Mr. Isaacson.
Thank you, Mrs. Isaacson.
That's your mother.
This is a question that came up during Ted's talk, and I held it because I wanted to get all three of you, and that is on the issue that on a donor advised fund, you have an opportunity to increase the value because it would be invested. Any recommendations as far as a strategy to use? Obviously, like the JUF gives you set options, array 10 options, going from all stock to probably cash. I don't know. Any advice for people that are in a donor or considering a donor advised? How much risk or non-risk would you recommend taking in a donor?
Adam, you want to take the first shot at that?
Sure, it's a great question. And I think that it's entirely dependent on what the cash flows look like that you're intending to come from the donor advised fund. So what I mean by that is, if I, let's say, put $20,000 in a donor advised fund, but I don't intend to distribute that money because there's no distribution requirements of a donor advised fund. So I just had my 50th birthday last Thursday. So let's just say I put money in. I'm like, Melinda and I say, hey, when Adam turns 60, then, he's going to make a gift out of the donor advised fund. Well, I would have an aggressive allocation because I've got 10 years before I'm going to distribute that money, right? But conversely, if I put in $20,000 in the donor advised fund and my intention is to give $5,000 a year out of that donor advised fund, then I'm certainly not going to have it all invested in stock for fear that it could go down. So then it's more of a balancing act, right? Like I want to have at least that next year's gift in cash, perhaps.
Mhm.
And then maybe each year when I give the $5,000 out, then maybe I would ratchet the degree of aggressiveness in it. But we generally, when clients are setting up the donor advised funds, they have an intention to use some of it now. And so it's usually a mixed combination of some conservative stuff and some growth stuff. So they can hopefully have their cake and eat it too, give some on the front end and then have some that's growing for later on down the line.
So Mike, I couldn't agree more with what Adam just said. But my experience is most people do the bunching or chunking on a 3 or 4 year cycle, right? So for most of our professional clients, they'll say, okay, I give $10,000 a year to charity. I'm going to put $40,000 into my donor advised fund the last 4 years. And after 4 years, I'll do it again. That's kind of what I see most often. And if you're talking about a 4 year cycle, you would probably be more on the conservative side than on the aggressive side, I would say. Maybe 30 to 50% stock. I'm just throwing some numbers out there, but something on that a conservative side. Some stock, because you do want a little growth, but not a lot.
I don't have anything to add to those two financial Hawkins there. So.
Great.
Thank you very much.
Other questions from those of you, Andy, Mark, Anita, Carla, Daniel, Ann? Ann, it looks like you're outside.
You're mute.
Good.
I'll
Well,
just say thank you. How's that? I didn't have any questions, but I just want to thank all three speakers. It's Mark Williams. So thank you very much.
Thanks, Mark.
You're informative.
I hope, oh, cute dog alert. I hope that everyone learned something. I find it impossible to think that I didn't learn something. I know it was a double negative, but I got a lot out of this as well. And I just want to, again, thank Adam and Ted and Stephen for your great knowledge, and Becky for helping organize this as well. It is 7:59, right on time, 8:59 in Florida, Stephen. And I just, again, thank those of you who attended or those of you who are watching this recording. So thanks so much. Good night.